All right. Hello, everybody. It's Joe Fahmy. Sunday, July 26th, a little after 7 o'clock Eastern. Thank you to everybody for joining. If you can't make it through the whole thing, it's going to be recorded and posted in the bonus content section of the website. What I first wanted to do before I get into some of the screening is just review some of the comments I made in the weekend video, just on my overall thoughts on the market right now. I could make a lot of positive cases or points for the bullish case in the market. I could also make a case for some reasons to be cautious. And as I mentioned in the weekend video, is when the signals are mixed, I'm going to do my best to lean towards the defensive side. Why? Because number one, the best traders I've studied throughout history, they preach defense, defense, defense. And number two, because part of my goal with this product is to keep people on the right side of the market and protect people. So I identified those follow-through days in early April, and we've been on the right side of the market since then with a lot of great stocks. And I always said, even if they are subtle or minor warning signs, I'm going to do my best to pass that along. And why I'm stressing the, let me just see, I think there's some comments that came in. Someone said, hi from Australia. Great. Awesome. It's early in the morning there. I appreciate you joining in. Why I'm saying this is that I want you to understand my perspective, meaning my feelings or my thoughts on the market are going to come from a little bit of a defensive side when there's mixed signals. However, this is where I really, really stress to know your own time frame. As I said, if you're young and you have a lot of tolerance for risk and you're in the market in some stocks from a lower level, then stick with the trend. There's nothing wrong with that. It's just going to be a little bit volatile. If you are someone like me that is a little bit more active with your investment levels, then there's nothing wrong with being a little bit defensive for two reasons, or having a little bit extra cash, because one, if we go down and correct a little bit, you won't get hurt as much. And two, you'll have some cash to put to work when we reach certain support levels. So I really want to stress that I'm by no means turning bearish, as I mentioned in the email I sent out on Thursday night and in the weekend video. I'm by no means turning bearish. It just never hurts to be a little bit cautious at times and lean towards a defensive side when there's some mixed signals, because as I said, I'd rather be safe than sorry. Now, I have a daily chart of the NASDAQ composite, and you might ask yourself, okay, when is there ever a clear picture in the market? And it's a fair question, because a lot of times the market's not clear. But as I mentioned, back in late February, March, when we had these distribution days and it was a clear signal the big institutions were getting out of the market, and we broke below the 50-day and broke below the 200-day and so forth, this is a clear time to raise cash, be super defensive, or even get out of the market completely, depending on if you're a trader or investor. Now, there are also times when I identified these follow-through days in early April, April 2nd on the S&P, April 6th on the NASDAQ. There are times when, you step on the gas and you can be very aggressive in the markets. And it was pretty clear to be bullish and be involved in the markets because there was tons of accumulation, tons of stocks were setting up. I never mentioned anything cautious during this time for the members who are with me at this time. It was pretty much just a lot of stock ideas, a lot of leaders to focus on. So my point is, there are times, yes, when it's pretty clear to get the heck out, and there are times to step on the gas. But as I said, for some people who hopped in late, when it's a little bit mixed, there's nothing wrong with leaning towards being a little bit defensive just in case. So hopefully that's clear. Now, before I get into some of the screens, I would like to review some of the positives and negatives. And I know there's some questions coming in, so I promise I will get to them. Reviewing some of the positives. The major averages are all above their 10-week moving average when I look at a weekly chart. So just to review, if I was stranded on a deserted island for years and years and years, and someone showed up and said, with a chart of the market and said, what do you think of the market? besides the fact that say, get the heck off my island, but and I wouldn't really care about the market, but that's not the point. My point is, if you were in a coma for years and someone gave me a chart of the markets and said, what do you think? The first thing I would do is look at the 10-week moving average, which is the red line here. That's the first thing I would say, just blind, stupid, simple analysis of the market. And why? Because that 10-week moving average is a great area, a strong area of institutional support. If we're above that, for the most part, the market's healthy and it's a green light to be in the markets. If we're below it, it's for the most part, things are starting to break down and be defensive. So one positive is I look at the NASDAQ, it's above the 10-week moving average. When I look at the S&P, I'll just go through some of the major averages. S&P is above this red line, the 10-week moving average. When I look at the Russell, we found nice support along the 10-week moving average the last few weeks while it's been consolidating. Keep in mind, the Russell made over a 40% move from under 1,000 to over 1,500 and consolidated. But the good thing is it consolidated above that 10-week moving average. And even when you look at some of the other averages, I don't really look at S&P Mid-Cap 400. I think MDY is the ETF associated with it. Same thing, above the 10-week moving average. So you get my point. The first positive is all the major averages are above their 10-week. Another positive is there's little distribution on almost all the averages, except on the NASDAQ. As I mentioned, you had this here. I believe in my notes, it was July 13th here. You had a distribution day, which is a down day on higher volume than the previous day. You had a distribution day this past Tuesday, July 21st, which was also a reversal as the NASDAQ had trouble getting above this sort of 10-8 range on the NASDAQ composite. And then you also had a distribution day on this past Thursday, July 23rd, which was 3 distribution days. Not a heavy distribution day, but nevertheless, 3 distribution days in 9. To get a top in the market, you usually see 4 to 6 in a month period or so. You can review the market tops video in the educational portion of the website. But it's not alarming. But as I said, if there's any minor warning signs, it's just something to pay attention to. And that's what I mean by a mixed picture, because I just said one of the positives is there's very little distribution, except on the NASDAQ there is some. When I look at the S&P 500, there's no distribution. In fact, Friday was a down day. Believe it or not, I was actually shocked by this. It was the lightest volume day of the year. Why that's important is, remember I talk about looking and analyzing volume and light volume days and heavy volume days. I was shocked it was the lightest volume day of the year, which is important because it shows that there's not heavy, selling from the institutions. And in fact, this whole time we've been consolidating here sort of in this range or trying to break out of this range. There's no distribution here at all. All the days are below average volume. So maybe, as I mentioned in the past few weeks, because the NASDAQ was a little bit extended, you could get some sector rotation where money comes a little bit out of the NASDAQ and rotates into the S&P and the Dow stocks, just to rotate money and have sector rotation, which makes it very difficult to short this market for a sustained downside because, for an extended downside, because the sector rotation is keeping things propped up. Also, when you look at the Dow, I don't look at the Dow too much, but same thing. This was the second lightest volume day of the year on the Dow. Very little distribution. I'm not seeing any big distribution above this 50-day moving average of volume. I'm seeing very little distribution, which is a sign of institutional selling, just not seeing much. And same thing with the S&P Mid-Cap 400. I know I don't talk about it much, but I do look at it holding up well, lightest volume day of the year. Just looking at all the major averages, Russell, lightest volume day of the year, still holding above its 10-week, above its 200-day. So that's a positive sign. So again, for people who hopped on late, one positive is all the major averages are above their 10-week. And I promise we'll get into some stocks in a minute. There's very little distribution except some subtle on the NASDAQ, something to keep an eye on. And the Fed is on our side. They are keeping interest rates low. As I've said for a while now, there's a globally coordinated effort to keep interest rates low and the markets high. A lot of people are skeptical and saying they're going to pull the plug on the stimulus any day. But when you listen to Powell, he's actually saying, I'm ready to double down. I'm ready to do more. Everyone's saying the Fed's out of bullets. I mean, if you have a printer that doesn't run out of ink, you really don't, you're never out of bullets. So my point is, if there is a second wave or a second leg down in the markets, I honestly think the Fed, I even joked about it in the weekend video, I think they have press releases ready to fire more bullets at this market if they need to. So the Fed's on our side. There's no sign of them, slowing down with their QE. Obviously, if a vaccine comes out, I know a lot of companies are working on it. That could be a positive as well. The negative that I'm seeing in the market is just very, very few setups. When we go through the screens, I'll explain that. For the newer members, 90% of what I use to judge the health of the market is the price action of leading stocks. Are we seeing stocks setting up, coming out of tight consolidations, breaking out on great volume, and working out? It doesn't mean the leaders are broken. The leaders are in strong uptrends. However, I'm just not finding too many setups right now, and that's one thing that's making me a little bit cautious. Number two is a seasonality. You tend to see maybe end of the month profit taking, but especially August and September traditionally and historically are two of the more difficult months in the markets, because most people from around July, August, and September and until Labor Day take time off and vacation. And also I mentioned that NAAIM number, which I put a link to in the email. I know it's only one sentiment survey, but it is showing a lot of people are getting little. It's the highest number of the year. So that's just what I mean by mixed signals. It's showing a lot of people are getting overly invested. I know it's only one sentiment measure, but again, it's just something to pay attention to. Now, one other thing I wanted to say, which is why I mentioned in that email, looking at the NASDAQ, it's possible we could pull back to the 50-day. And someone emailed me and said, what do we do? What if we pull back to the 50-day? And my initial sort of facetious response is, we just moved from 6,600 to 10,800. We moved up 4,200 points. To pull back 700-800 points in the grand scheme of things would be normal. I'm not saying it's going to happen, but that really wouldn't be horrible. If you can't deal with a drawdown or a pullback like that, I mean, I'm sorry, you shouldn't be in the markets. The markets don't go up every single day. I'm not saying it's going to happen tomorrow. I'm just saying possibly, potentially, because I'm here to give you a heads up, not warn you, but give you a heads up in case we do see stocks building new bases and the market pulling back a little bit. A pullback to the 50-day would actually be normal. Now, what I'm judging this on, or what I'm basing this on, is two precedents. I'm going back to 2000. And the precedents I'm talking about is two periods. I've been doing this a little over 21 years, two periods that I can remember when there's been tons of liquidity pumped into the markets. So the analogy, I'm not looking at 99 because it was a bubble and in the dot-com bubble. I'm strictly saying the analogy is liquidity. Back then, there wasn't social media, so everyone didn't know about this. And there also, wasn't a lot of news channels covering this, but the Fed did their own version of QE. They doubled the M2 money supply, pumped tons of money into the system, didn't raise interest rates. Why? Because of Y2K. They were worried at December 31st at midnight in 99, the world was going to blow up and every computer was going to blow up. And because no one had any clue what was going on, they pumped money into the system. So, and I promise we're getting to stocks in a second. But my analogy here is, when you look at October of 99, similar to what we're seeing now, we had these pullbacks to the 21-day, but eventually we had a pullback to the 50-day, the red line here, just after a move to consolidate. And that's all I'm saying is, be open-minded. We've had a nice move. We can correct through time, not necessarily through price, meaning we can go sideways before possibly heading higher. One other analogy was 2010, which was, I'm just going to go back to show you, let me go back to, let me show you 2010, which was QE2. And I'm going to go back on the chart to show you this. This was September 1st, 2010, QE2. We came out of, just to give you a little background, we came out of 08 and 09, housing crisis, financial crisis, and they did TARP and TALF and QE1 and all these stimulus programs. When all those ended and the market was in a correction, Ben Bernanke at the Jackson Hole Symposium, September 1, 2010, came out with QE2, which at the time was just huge, huge stimulus, huge liquidity. Again, sorry to ramble, but the analogies with now, 2010, 2000 was huge stimulus into the markets. And even during that period, we grinded up, pulled back to the 21-day, grinded up, and we still had a similar sort of pullback roughly to this 50-day before potentially heading higher. That's all I'm saying is there's a lot of liquidity right now. Let me reset this back to today. There's a lot of liquidity right now, but at similar times in history where we've seen this liquidity, a pullback to the 50-day on the NASDAQ would be perfectly normal. And just keep in mind, there's a lot of sector rotation, and we can correct through price and not through time. I'm going to go through some screens right now. Let me look at a couple questions. Hi, Joe. If we see a pullback to the